go ahead and get started. I'm Christine Benz. I work for Morningstar. I have been with Morningstar since 1993. I started as part of our fund analyst research group and eventually headed up that team, but along the way got more interested in broader matters than security selection. So I became more interested in retirement planning, asset allocation, and those are the things that I focus on primarily in my work on Morningstar.com. Morningstar, for some of you who may not know, is an investment research provider. We're independent. I sometimes encounter people who are like, veggie burgers, right? And it's not that Morningstar, it's a different Morningstar. But the way I explained it to my mom when I joined Morningstar 26 years ago was, I think of us as kind of the Consumer Reports of the investment information industry. So we don't have a vested interest in whether you do your business with Fidelity or Vanguard or Schwab. Our goal is to help provide independent research to help you draw your own conclusions about your best partners for your financial investments. So one of my key preoccupations for the past decade or so has been the logistics of retirement decumulation. And I was sparked to work in this area by talking to my father-in-law. My dad had always been a long-term equity investor, and he was comfortable selling stuff when they hit his price targets. So he was used to this process of decumulation simply because he had been a valuation-conscious equity investor. My father-in-law was one of these income-centric retirees who wanted to live off of whatever his portfolio kicked off in terms of organic income. And I remember he came to me one day and said, Christine, I'm thinking about putting $100,000 into this GM bond. It has the kind of yield I'm looking for. And I knew my father-in-law wasn't investing $10 million. And so I thought to myself, well, gosh, that sounds pretty undiversified. And I'm not sure about, I'm not an equity analyst, but you know, I know that those automakers can be pretty cyclical, and it just got me worried in talking to him and in talking to a lot of other retirees while I was out and about speaking, that many of them were similarly income-centric and constructing portfolios that frankly concerned me because in the name of producing income from that portfolio, they were creating portfolios that were pretty risky. So I started to toil on this project of talking about the logistics of creating retirement portfolios and extracting cash flows from them in a way that keeps the portfolio balanced, that keeps the portfolio growing, and isn't disproportionately focused on income, which does not mean I don't like income-producing securities. I absolutely do. I think stocks are great, for example, but I like the idea of a well-rounded, well-diversified portfolio that happens to contain some income-producing stocks. So that's kind of my approach, and that's what I'm going to be talking about today. I'm going to share later on in the presentation, and this is a presentation that really is meant for like an hour, but I'm going to share some work that I've been doing on this bucket strategy to retirement portfolio planning, and I'll share some specific model portfolios that I've created using this bucket structure. But I was really compelled to work on this bucket approach in talking to Harold Avensky, who's a financial planner in Coral Gables, kind of the dean of financial planning and just someone who has really influenced my thinking about financial planning and retirement planning. And he said to me probably a decade ago, maybe 12, 13 years ago, that with his clients, he maintains a long-term investment portfolio, but he bolts on this cash bucket, basically. So he has a couple of years worth of living expenses set aside in cash instruments, and then the long-term investments can do what they'll do, but the retiree knows that a couple of years worth of living expenses are stable and battened down. And he pointed out to me that that strategy has been really working for him and his clients because it addresses some of the behavioral factors that we know are in play in retirement. That people get more nervous when they see their investment portfolios go down when they're drawing from that portfolio. And knowing that you have enough near-term reserves set aside can help you make peace with the long-term piece of your portfolio. So I'm going to share some details on these model bucket portfolios that I've been working on. I haven't been creating these portfolios with an eye toward beating any other retirement strategy that's ever been devised. My idea is just to help people figure out, well, what's a portfolio structure that I can live with throughout my retirement? And chances are, if you've got a well-diversified portfolio, you probably have most of the raw materials you need to do something like some of the model portfolios that I've created. So just a quick overview. I'll just spend a couple minutes talking about some of the challenges facing retirees today. These will be familiar to most of you, I would imagine. Then I'll talk about what I think are the 7 keys to a successful retirement portfolio plan, and then I'll get into these bucket portfolios. So challenge 1, we often in retirement planning circles talked about retirement planning being a 3-legged stool, or retirement plans being a 3-legged stool, where you have Social Security, you have a pension, and you have your own savings. Well, guess what? There are more and more of us coming into retirement with this 2-legged stool, and I'm one of these people where I'll have Social Security, I hope, and I have my own investments, but I do not have a pension. And that's the case with more and more folks coming into retirement, where they have saved throughout their careers in the defined contribution space. They do not have the benefit of pensions. Some people still do, but pensions are gradually ebbing away to a point where they're very rare in the private sector. So in 2011, the number of people covered by some type of pension had dropped to about 20%. My guess is that that has dropped further still over the past several years. So this has been a challenge, certainly, because people haven't necessarily addressed the fact that they will not have those pension payouts in retirement through their own savings. So when we look at retiree savings levels, you can see that they sort of peak in the 65 to 74 period, but nonetheless, the average retirement savings portfolio for someone in that 65 to 74 year age band is about $145,000. So if you're familiar with the 4% guideline for retirement portfolio withdrawals, which says that you can take about 4% of that portfolio initially in retirement, well, you can see that that $145,000 balance translates into about a $5,600 withdrawal, which certainly, even combined with the highest Social Security benefit, which I think is now about $36,000 a year, that is not a subsistence level income stream for most people. So this is a headwind that we have not seen personal savings rates pick up the slack where defined contribution plans left off, or defined benefit plans left off. So this is another challenge. Things are getting better on this front, but we've had this headwind of steady drip drop downward in interest rates for the better part of 3 decades. And now we're starting to see a little bit of a reversal. I was looking at cash accounts recently. Citigroup recently came out with a 2.48% online savings account, which is a pretty compelling yield relative to what we had gotten used to. But we did see yields drop precipitously across the board, and that took everything down. So cash yields were down, bond yields, as you know, were down as well. So the raw materials that people, income-centric investors, look to provide their income for living expenses just weren't there, especially over the past decade. So that was certainly a challenge as well. And it had the net effect of pushing people like my father-in-law out on the risk spectrum from probably where he wanted to be, because yields were so low on higher quality bonds. So yields still aren't especially encouraging for people who want to try to extract all of their cash flows from a high quality portfolio. So I just grabbed these statistics this morning. So these are current yields. The Bloomberg Barclays Aggregate Bond Index is currently yielding just over 3%, which is a big pickup from where it was. Intermediate Treasury bonds under 3%, intermediate term munis about 2.5%. Even if you are willing to venture all the way out on the interest rate spectrum and invest in a long-term bond product, well, guess what? yields are still in the neighborhood of 3%. So for people who wanted to extract, say, 4% from a portfolio, you're not there with a high-quality bond portfolio. One thing I often tell people to do, if you have fixed income investments in your portfolio, this is just a little detour, run them through what I call a duration stress test. And we actually had a little bit of a duration stress test in 2018 where we saw bonds get jostled around pretty well by some of the Fed's actions. But if you have bond funds in your portfolio, find a couple of statistics for them. So find a data point called SEC yield, which is Securities and Exchange Commission yield. That's a recent snapshot of funds' current yield, and find duration. So find those two numbers and subtract the yield from duration, and the amount that's left over is roughly the amount that you would expect that product to lose in a one-year period in which interest rates trended up by 1 percentage point. So to use this long-term Treasury index as an example, it has a duration of 17 years, a yield right now of just over 3%. So you can see that's a roughly 14% shock to the fund in capital losses due to the rate spike. So that's something to run through. I think if people look at your typical intermediate term bond fund, you'll see a duration in the neighborhood of 5 or 6 years today, and yields getting better, so maybe a 2.5–3% yield. You may be somewhat comforted by the fact that even though bonds will be jostled around by interest rate changes, it might not be as bad as you imagined. Unless you have a long-term product in your portfolio, you probably won't experience losses like these. But nonetheless, something to think about if you have bond holdings in your portfolio. So what about lower quality bond types? Well, one interesting thing is, and I was kind of surprised by this when I pulled these numbers this morning, we've seen yields actually start to look a little better among some of these security types. So there had been a point just even like 6 months ago where high yield bank loans, which have floating rates that reset along with the prevailing interest rate environment, yields have picked up there as well. So this one is the fact that we've seen yields pick up across these bond types suggests to me that investors are a little bit more concerned about risk here than before. They're demanding higher yields in compensation for holding these bond types because they're getting a little bit more concerned about creditworthiness. So we see that relationship come into play recently. A year or so ago, I think investors were more complacent, more comfortable with taking credit risk. Now it looks like investors who are taking credit risk want to get paid for it. And then I've also included on this slide the fact that any bond type like this, a lower quality bond type, and I would put all of these fixed income securities into that category, you tend to get a lot more equity sensitivity. You get a lot more sensitivity to what's going on in the economy. And so I've included 2008 losses just to kind of provide an indication of what one might expect in a severe equity market shock. The losses on these securities were not in line with equities. I think the S&P lost like 37% in 2008, but nonetheless directionally quite similar. And if you're holding bonds in your portfolio to be the shock absorbers for your equity portfolio, which I would argue is the main virtue of holding bonds at all, you're not getting them with these bond types. And that was sort of what I concluded when my father-in-law wanted to buy the GM bond. I was like, okay, you're getting something that is going to act like this as opposed to something that is going to be the safe bond that you hoped it to be. So, which is not to say you should ignore these fixed income types, but just that they will not be ballast for your equity market portfolio. They will not necessarily gain value. They may go down when stocks go down. So I'm just going to get right into these keys to successful retirement portfolio planning. The first one is just making sure that your portfolio has adequate protection against a long life. And this slide, I think, in so many ways is a good news slide in that it depicts that the ratio between working years and years retired has generally been declining over the past several decades. So now people are working fewer number of years and being retired longer. So that's a positive story from a lifestyle component, but nonetheless it creates challenges for the investment portfolio. So just a couple of additional data points on life expectancies. The first two numbers are from Social Security Administration, where the average 65-year-old male can expect to live another 19 years, and the average 65-year-old female can expect to live 21 years. And the next statistic, I think, is a real doozy, which is that if you are part of a married couple and you're both 65, there's roughly 1 in 3 odds that one of you will make it to age 95. So if you are embarking on retirement at age 65, that means you need to be planning for a 30-year time horizon. And that means you need to build that portfolio to last. That you can't just batten down the hatches in cash and bonds because you won't have any growth in that portfolio. So how do we get longevity protection into our plans? Well, at the top of the list would be to make sure that we're not taking out too much. And I'll spend some time later on in the presentation about withdrawal rates. It's a really important topic. We could do the whole session on setting your withdrawal rate. But making sure that you're taking a reasonable withdrawal rate is obviously at the top of the list. Second would be within your investment portfolio, making sure that you are investing adequately in securities that do offer growth potential. So in all of the model portfolios that I put together for Morningstar.com, they have roughly 50% equity weightings because the portfolio needs to last over that long time horizon. Another key point I would make on the longevity protection front, and I'm sure many of you have heard this many times over, is the virtue of maximizing Social Security, and potentially, if you haven't started tapping Social Security yet, potentially being willing to delay receipt of benefits a couple of years. I've been working with my sister on this. She just retired and sold her business last year, and she's just starting retirement. And we know we have some longevity in our family, and she's in great health herself. And so she's decided to wait until age 70, actually, and start tapping her other assets first in an effort to enlarge her eventual Social Security benefit. She has said that her business partner, and they just sold this business together, that he has decided that he started taking Social Security right when he was eligible at age 62, and he thinks she's crazy. But she and I know, we know what we're doing, and we know that she's wise to delay if she can, and she can. If you are someone who's lucky enough to have a pension, you are typically offered a lump sum or an annuity payment from the pension. The virtue of annuities is that it's a lifetime income stream, and so if you're concerned about longevity, considering the annuity option on the pension payout is often the better decision. If you don't have a pension, I think it's worthwhile to consider allocating a portion of your investment portfolio to some type of an annuity product. There's been a lot of academic research that's supportive of holding annuities as a portion of the retirement toolkit. And I think a lot of educated investors' hackles automatically go up when they hear annuities. They know that annuities are often really costly. They're not at all transparent. But the type of annuities that I like and the type of annuities that academic research points to as being additive to a retirement plan would just be the very vanilla, low cost, either an immediate annuity or a deferred annuity, but no bells and whistles, just the very basic annuity types. It's quite easy to compare different products, and that's a way to add some additional longevity protection in addition to Social Security, which is obviously a lifetime benefit as well. So another key, in addition to longevity protection, is just making sure that you have adequate liquidity in the portfolio. And this slide gets at the risk of having a fully invested portfolio, stocks and bonds, and no cash component. So you can see that in a year like, or in a period like 2007 through 2009, a portfolio that was reasonably well diversified, so 60% equity, 40% bond, would have dropped about 35% during that period. And withdraw from the cash piece to let the other components of the portfolio heal. So you get liquidity in, this is another slide that amplifies the point for having liquidity in a portfolio. Well, one reason is against the equity, to help you against the equity market shock that we just talked about. Another one would be, and I often encounter investors who are big adherents to dividend-paying stocks, who love dividend-paying stocks. But one thing we saw in the financial crisis was that a lot of dividend-paying stocks, namely banks, cut their dividends. So having some cash on hand, even if you are someone who likes to extract income from your portfolio, can help tide you through that difficult market environment if something happens to whatever was creating income for you. Having adequate liquidity can also help shield you against a period of rising interest rates, which can hurt bond prices. So how do we get liquidity? Well, I think you just simply need to look at the very plain vanilla cash instruments. So that's CDs, money market accounts, high yield savings accounts. And I think the key here is have liquidity, but don't overdo it. So for most retirees, when I talk about this bucket approach to having some liquidity in the portfolio, I talk about keeping that to 1 to 2 years worth of portfolio withdrawals. So not total living expenses, but just however much you plan to extract from your portfolio, keep 1 to 2 years worth of that in cash. And that can, I think, allow you to feel a little more comfortable if your longer term positions in your portfolio are gyrating around a little bit. So another key component to retirement portfolio plans is making sure that you have inflation protection. And there are a couple of key reasons why you want to think about this. One is that your own consumption basket may change in retirement versus what it was when you were working. And one thing we know is that for retirees, healthcare expenses are a larger share of their outlay, whether for drugs or co-pays, mainly drugs, that they might take, that is a bigger component of their consumption baskets, and we've also been seeing healthcare expenses inflate at a higher rate than the general inflation rate. So to me, that suggests that you need to concern yourself more with inflation than when you are working simply because your consumption basket has changed. Another thing to think about is that in retirement, you won't automatically receive cost of living adjustments from the portion you withdraw from your portfolio. So in contrast to when you're working and you are typically eligible for some type of cost of living adjustment, your portfolio isn't automatically going to give you that. So you need to make sure that you're embedding that within your portfolio. And that's especially true for people who have heavy allocations to fixed rate securities, whether bonds or cash. Because if inflation ticks up, and it has been pretty mild for the most part, but if inflation ticks up, that's just going to eat away at the purchasing power of those fixed rate investments. So those are a couple of reasons why to make sure that your portfolio has some inflation protective abilities. So how do we get it? Well, in terms of the portfolio, the pure inflation hedge is a security type called Treasury Inflation Protected Security, or a TIPS bond. I-bonds also work like this, where you get an inflation adjustment in addition to the yield, or in the case of a TIPS bond, you get an inflation adjustment at the principal level. So TIPS provide a hedge against inflation. I-bonds, which you can buy directly from treasury.gov, do that as well. So that's the pure inflation hedge. And so I would recommend that anyone who has fixed rate investments in their portfolio think about allocating a component to TIPS bonds. The fund I often recommend is Vanguard's short-term inflation protected securities. The ticker is VTIP for the ETF and VTIPX or VTAPX if you're in Admiral shares at Vanguard. But that product I like because TIPS, intermediate term TIPS, can be very interest rate sensitive. This short-term fund is more or less pure inflation protection. So TIPS are one category to consider. Another category, and this is another feather in the cap of making sure that your portfolio has equity exposure, is just making sure that you have adequate equity exposure. Equities have the best long-run shot at beating inflation over time. A couple of other categories to consider would be bank loans. I showed on a previous slide how they tend to be quite sensitive to what's going on in the economy. They tend to behave in sympathy with stocks, but they also, because their yields reset with the prevailing yield environment, they also tend to behave pretty well in inflationary environments. So that's one category to consider, at least in small doses. I wouldn't go overboard with floating rate investments or bank loan investments, but I might dedicate a small allocation to them. You might also consider some sort of a REIT component to a portfolio, and the virtue is that REITs are able to benefit when rents go up. So as inflation goes up, rents typically go up as well, and the REIT is the beneficiary of such an environment. So that's another reason why you might consider some sort of REIT component in a portfolio. High yield bonds, when we look at various categories that tend to behave well in inflationary environments, high yield is another security type that does well. Additionally, apart from portfolio strategies, you might also consider delaying Social Security. So that's another feather in the cap of delaying Social Security, because the increased return that you are able to earn for delaying past full retirement age also gets a little inflation adjustment. And finally, if you're purchasing an annuity type, you can sometimes add a rider that will adjust your payments to keep pace with inflation. That's something worth considering as well. Withdrawal rates, I mentioned that this is one of the most important topics when we think about successful retirement portfolio plans. This slide, I apologize, it's probably too basic for words, but we're just looking at how higher withdrawal rates tend to drive someone to run out of money sooner than would be the case if someone used a lower withdrawal rate. So you can see on this slide that the person using the 5% withdrawal rate ran out of money in 20 years over this terrible time period to be retired, whereas the person who withdrew 9% of his or her portfolio was out of money in just a decade. So this is just a very basic slide. This one's a little more complicated. What we're looking at here is the right withdrawal rate over various 30-year time horizons. So the right starting withdrawal rate. And you can see that this is varied significantly with time, or maybe you can't see because it's pretty tiny. The dark blue line is the most equity-heavy portfolio mix. So that's a 75% equity, 25% bond mix. The sort of slate blue line is a 50-50 portfolio, and the green line is a portfolio with just 25% in stocks and the rest in bonds. So you can see that the more aggressive portfolio mixes were able to take higher withdrawals over almost all time periods. But where everything ran into trouble was in this period here. And so this is people who were embarking on retirement in the late 60s, early 70s. This was the mother of all terrible environments to retire into. So you can see for someone who had the bad luck of retiring in this period, no matter what allocation you came into this period with, nothing was good. We had a big equity market shock in 73, 74. We had runaway inflation through a lot of the 70s, which killed bond prices. So this is where Bill Bengen, the financial planner who was the originator of the 4% guideline, came up with 4%. He found that for someone who was planning like a 25 to 30 year time horizon, they could have taken 4% initially and then given that dollar amount an adjustment thereafter, but no more than that. And so that's why a lot of people have anchored on that 4% guideline as at least a starting point for thinking about your withdrawal rate. Because over the worst market environments that we've observed, that was the most one could take without running out of money. It's not a one-size-fits-all answer, but it's nonetheless a starting point for thinking about your withdrawal rate. This slide kind of illustrates the same topic, but I think even more than anything illustrates what we call sequencing risk. So this risk of encountering a lousy market right out of the box in your retirement. That's the thing that retirement researchers tell people to worry about. And frankly, when I think about my sister just retiring, that's what I'm worried about for her. She's been an equity investor for most of her career. I was looking at her portfolio the other day. She has a lot of equity investments, but the real killer is if you encounter that bad equity market environment right at the beginning of your retirement and you're simultaneously spending from it and you're spending too much from it, well, you're not leaving enough in place to heal when the market eventually recovers. So this slide was prepared by my colleague David Blanchett, who focuses on retirement research for us. And on the left-hand side, and I'll describe it because the print is super tiny, but on the left-hand side we have the actual historical return sequence that someone who had a 50% stock, 50% bond portfolio would have experienced. So assuming a $500,000 portfolio, 50% stock, 50% bond, and a 5% withdrawal rate, we talked about the early 70s being a terrible environment to have retired into. That's what this person experienced. So their withdrawal rate was too rich, given that they hit that lousy market environment right at the beginning of retirement. So taking 5% was too much because they're out of money in 20 years, which is a fail, right? Because you're thinking about a 25 to 30 year time horizon in retirement. Taking 5% was too much over that time horizon. Well, what if you had actually flipped that sequence of returns? And the good returns we earned in the last half of the 80s and early 90s actually occurred at the outset of the time period. Well, you can find that a person using the very same withdrawal scheme, so 5% withdrawals on a 50% stock, 50% bond portfolio, would have not only not run out of money, but actually grown his or her portfolio quite nicely. And the unfortunate part of all of this is that for all of us, it's just luck of the draw. You do not have necessarily a lot of control over the specific environment that you retire into. What you do have control over is your withdrawal rate. So if your beginning of your retirement happens to coincide with a terrible market environment, one of the best things you can do is really try to rein in what you pull from that portfolio, and also try to manage how you have that portfolio allocated so you have enough safe securities that you're not pulling from things that are simultaneously dropping in value. So I'm going to have to zip through this because we have a lot more material to get through. I do have my email address at the end, so for people who would like to get a copy of my slides, I'm happy to send you a PDF of those, and I'll project my email address at the end. So I'm just going to zip through this because we don't want to go overboard on withdrawal rates, as important a topic as it is. Maximizing non-portfolio income sources. This is not something that I'm going to spend a lot of time on either because we've already talked about the virtue of making smart Social Security decisions, maybe getting some help on that front if you're unsure and haven't yet begun claiming Social Security, but just making sure that to the extent that you're bringing pensions or annuities or anything like that into retirement or thinking about them as part of your retirement toolkit, just make sure that you're really considering smart decision making because it'll be really impactful in terms of your portfolio's ability to last and your ability to have enough money throughout retirement. Tax efficiency, this is a topic that I spend a lot of time on in my work at Morningstar because I think it's pretty interesting, and also I think it's one of the few levers that we investors actually exert a little bit of control over in terms of the tax management of our portfolios. So just a quick review, if you have traditional tax-deferred accounts. You are subject to ordinary income tax on withdrawals from those accounts in retirement. You're also subject to required minimum distributions on traditional IRAs, as well as 401ks, as well as Roth 401ks, weirdly enough. So these accounts are the main savings vehicle for many of us. In fact, I've been contributing to my Roth 401k in earnest for about a decade now, but my traditional 401k balance is still bigger than my Roth 401k balance because I contributed within the confines of a traditional account for so many years. So many of us have most of our assets in traditional tax-deferred accounts. Once those RMDs commence, as some of you may know, once you're post age 70 and a half, that represents kind of a loss of control over your tax situation, that you owe ordinary income tax on those withdrawals, whether you like it or not. For taxable accounts, you actually have a little bit more flexibility. You have the ability to earn long-term capital gains treatments on securities that you've held for a year or longer. Which is one reason why I often recommend that investors prioritize tax diversification. So in addition to saving in traditional tax-deferred accounts, which give you a little bit of immediate gratification because you can oftentimes deduct the contributions, you also want to make sure you're holding taxable accounts as well as Roth accounts. So tax diversification, I mentioned, is an important concept, as is asset location, and this is a topic I've written a lot about on Morningstar.com. If you have taxable assets, just making sure that you're taking care to focus on tax-efficient assets. So that means equity exchange-traded funds, equity index funds, to the extent that you hold individual stocks. Taxable accounts can often be a good receptacle for them as well because you have control over when you realize capital gains. If you're retired, withdrawal sequencing is a key component to reducing the drag of taxes on those withdrawals. This is an area where if you're not comfortable with tax matters and you have a tax-savvy financial advisor or maybe an investment-savvy tax advisor, if you can work with him or her to get some guidance in retirement on the right accounts to pull from on a year-to-year basis with an eye toward reducing the drag of taxes, that can be money well spent in my view. Succession plan, I just want to touch on this. I had a dad who suffered from dementia, and I was his investment buddy. He actually didn't encounter cognitive decline until his mid-80s, but I had been his overseer, his helper in terms of working on his portfolio, and I was glad I could be there and help him. And I think about a lot of audiences who I speak to where they're kind of the main financial decision maker in the household. And I just want to make sure that everyone has someone or some sort of plan for succession in case, for whatever reason, you can't do this yourself or don't want to do it yourself. So just a couple of key things I would stress. One is just to try to reduce the moving parts in your portfolio, especially if you come into your later years. I think having less complexity is a good idea no matter what your age, but especially so for older investors. I'm also a big believer in this idea of documenting all of your investment accounts on just a spreadsheet or write it down on a piece of paper, whatever. If it's a spreadsheet, you'd obviously want to keep it in an encrypted document because you have account numbers there and so forth. And by the same token, if it's a written document, you'd want to keep it in some sort of a lockbox or a safe deposit box. But nonetheless, just creating some simple directory of here's what I have. And I actually have one of these, and my sister has it because she's my executor. But I think it's important to just have some basic documentation of here's what we're up to. Here's how we have our accounts, here's where we hold them. If I deal with people at certain financial institutions, here's the person I deal with. as comprehensive as you can be without going overboard on this front, I think is really valuable. Another point I would make is that even if you've been an avid do-it-yourself investor for all of your investment career, I think it's wise to start bringing on either a very trusted adult child or some sort of financial advisor to help keep a check on your portfolio plan as you age. So just a couple of points on that. One thing I often say is to look for someone who is a fiduciary, and if there's any hemming and hawing on whether they're a fiduciary or not, that's probably your answer. So ask, are you a fiduciary? Are you a CFP? And also, how do you charge for your services? And I prefer advisors who are fee only. So just a couple of things, probably nothing too worth spending time on, just the importance of having some basic estate planning documents, and also making sure that you've investigated some sort of coverage for how you'll pay for long-term care. I want to spend just a couple of minutes on this bucket approach. This is just a very simple time-segmented strategy here. So here we're using our spending needs in retirement combined with having the probability of having a positive return over that spending horizon. So for money I expect to spend within the next couple of years from my portfolio, well, I don't want to mess around because I don't want that to mean that I can't go out to the movies or go to dinner. I want to make sure that I have the money battened down in true cash investments. And again, these are just portfolio withdrawals, the amount that you would withdraw from your portfolio because you're probably getting cash from some other sources, whether Social Security or a pension. So this is just what you plan to withdraw from your portfolio. You've got that in cash. Then with bucket 2, well, you're stepping out on the risk spectrum a little bit because cash has a big opportunity cost. You need to earn more money on that portion of the portfolio. So in my basic bucket structure, which would be for the next 8 years worth of retirement, we've got a generally high quality bond portfolio. You might hold a little bit of a component of dividend paying stocks. Here's where you might hold that inflation protection, like a Treasury inflation protected securities product. So we know that bonds over time horizons of less than 10 years are extraordinarily reliable. So even though they might get jostled around a little bit by interest rate changes in the short term, bonds have positive returns most of the time, or nearly all of the time, if you have a time horizon of 5 years or longer. For the longest term piece of the portfolio, this is the growth engine of the portfolio. This is the longevity protection in the portfolio. So here I've earmarked this for spending, portfolio spending for years 11 and beyond of retirement. And you can afford to take more risk in this portfolio because we actually know with stocks, more than 90% of the time over rolling 10-year periods in market history, stocks have had a positive return if you have that 10-year time horizon. If your time horizon is shorter than 10 years, you need to be careful with stocks because they won't always have a positive return. But you're pretty well set in terms of probability, in terms of time horizons longer than 10 years. So this is the basic structure. I'm just going to zip through to some model portfolios. This is a mutual fund portfolio, and you can find these on Morningstar.com as well. On .com, they're actually expressed as percentage allocations. All of my stuff on Morningstar.com is part of our free site. Morningstar also has a paid site which includes all of our analyst reports. So for individual stocks and funds and ETFs, all that stuff is behind the premium wall. Articles like my work is all part of the free site. So you can see that this just has a liquidity bucket for 2 years worth of living expenses. So we're assuming, on the previous slide, we're assuming that we've got a 65-year-old couple with a $1.5 million portfolio. So assuming they're using the 4% guideline, that's a $60,000 year one withdrawal. So we've taken that and multiplied it by 2 to come up with that $120,000 in cash. And then we've just stepped out on the risk spectrum a little bit with bucket 2. So we've got a short-term bond fund, we've got that short-term Treasury inflation protected fund. We've got Harbor Bond, which is kind of a no-load version of PIMCO total return. And we've got Vanguard Wellesley Income, which is like a 70% fixed income, 30% dividend paying equity portfolio. So that's going to cover another roughly 8 years worth of living expenses. So 60,000 times 8 years. And then bucket 3 is the growth piece of the portfolio. This is the remainder of the portfolio, and it is largely a globally diversified equity portfolio. I have stashed a little bit of lower quality fixed income in this portfolio in Loomis Sales Bond, which tends to dabble in lower quality bonds, as well as a little bit of emerging markets bonds, as well as sometimes equities. So just going to zip through this. This is an ETF version with very similar contours. I guess a major point I would make on these model portfolios is not to upend anything that you're already doing. If you have carefully chosen securities, it's just kind of a lens to view your retirement portfolio plan through. So I'm getting the signal to wrap it up, and I will. These are some stress tests that I've been doing on Morningstar.com. I just published the latest version of this. And again, you know, I'm not looking to blow the doors off of any other retirement strategy, but I'm really just really aiming to illustrate on a year-by-year basis how this thing would work in terms of extracting cash flow from the portfolio. Did it work? And when we look back over the past period from 2000 through 2018, it worked pretty well, but I would say we also have what my geeky colleagues would say, we have positive end date bias here, because we have had a pretty good market environment over this 19-year period that arguably makes us look smarter than we are, or probably makes any reasonable retirement strategy look all right. I think the big risk will be over the next decade, and I think that's the virtue of making sure that you have adequate exposure to safe stuff in your portfolio, even as you have exposure to growth securities as well. So I'm going to end it there. I am going to put my email address up here in case you would like a copy of the presentation. I'm happy to send you a PDF of that. It'll probably be early next week. But anyway, thank you all for your attention. Enjoy the rest of the show.